integrated way to what is strictly needed from a prudential perspective. This cannot be done overnight, of course. As government finances improve, the scope for such reduction will increase. Furthermore, as the penetration of other financial institutions, such as pension funds and insurance companies, increase, we can reduce the need for regular commercial banks to invest in government securities. We also subject our banks to a variety of priority sector lending requirements. I believe there is a role for such a mandate in a developing country. It is useful to nudge the banks into areas they would not otherwise venture into. But that mandate should adjust to the needs of the economy and should be executed in the most efficient way possible. Let us remember that the goal is greater financial access to all parts of the country, rather than meeting some bureaucratic norms. I'm asking Dr. Nachiket Moore to head a committee that will assess every aspect of our approach to financial inclusion to suggest the way forward. In these ways, we will further the development mission of the RBI. Some see financial markets as competition to banks. They are that, but they're also complementary. Too many risks in the Indian economy gravitate towards commercial banks, even when they should be absorbed by arm's-length financial markets. For our financial markets to play their necessary roles of providing risk-absorbing long-term finance and of generating information about investment opportunities, they have to have depth. We cannot create depth by banning position-taking or mandating trading based only on well-defined legitimate needs. Money is fungible, so such bans get subverted, but at some level all investment is an act of faith and of risk-taking. Better that investors take positions domestically and provide depth and profits to our economy than they take our markets to foreign shores. So together with the government and regulators such as SEBI, we will steadily but surely liberalize our markets, as well as restrictions on investment and position-taking. Given the current market turmoil, our actions will be at a measured pace. But as a symbolic down payment, we will do the following. First, presently exporters are permitted to rebook cancelled forward exchange contracts to the extent of 25% of the value of cancelled contracts. This facility is not available for importers. To enable exporters and importers greater flexibility in their risk management, we will, 1, enhance the limit available to exporters to 50%, and 2, allow a similar facility to importers to the extent of 25%. Second, to develop the money markets and the GSEC markets, we will introduce cash-settled 10-year interest rate futures contracts. Third, we will examine the introduction of interest rate futures on overnight interest rates.